This is Janus Dispatch, Architecture over Narrative. Today's topic: access is not a market. And what if settlement will follow the route? A settlement system is a claim about who has to trust whom. That claim is being renegotiated in 2026. The fiscal mechanics started moving first, in December 2025, but stayed technical and unremarked until a physical route made the same logic visible to anyone not reading Fed minutes. This analysis follows one chain. From fiscal mechanics, through geopolitics, to the question of which asset ends up carrying the role. It does not end at a verdict on that question. The evidence for one is not there yet. It ends at the gap itself, which is a finding on its own. The issuer blinks. On August 17th, the 30-year US Treasury yield touched 5.33%, the highest level since 2007. The 30-year Bund reached 3.78%, the highest since 2011. Two independent issuance regimes in two different currencies, moving the same way in the same week. 2 days later, the US Treasury doubled its long-end buyback operations, from $2 billion to at least $4 billion per operation. Mid-quarter, though moves of that size are normally set at the quarterly refunding, not announced between refundings. Risk assets jumped, and between $1.4 and $1.6 billion of short positions were covered within hours. A relief reaction to a friendlier issuer, which is not the same thing as evidence that the market now intends to probe a defended line. Whether it does that is a separate question 1 week's price action cannot settle. $96 billion a year is 0.33% of marketable debt outstanding, arithmetically negligible against a stock measured in the tens of trillions. Too small on its own to defend any specific yield level, and nothing in the public record pins 5.33% as a line the Treasury has committed to hold. Read generously. This is routine liability management that happened to land in a stress week. Treasury has doubled buyback sizes before without anyone reading a doctrine into it. Read less generously. A mid-quarter doubling outside the normal calendar disclosed a willingness to move before the next scheduled window rather than wait for it. The second reading is the more likely one. The first has not been ruled out. Scale the cost against the benefit and the operation looks small either way. A quarter point of yield across a rollover base of roughly $10 trillion adds close to $25 billion a year in interest expense, more than the entire annual buyback program is sized to absorb. The buyback cannot offset a yield move of that magnitude on its own. What it can do is signal that the issuer would rather intervene, however modestly, than watch the long end reprice unopposed and say nothing. The buyer nobody calls QE. If the long end is being managed from the issuer's side, the next question is what is happening at the short end, where buyers are supposed to show up without anyone's help. The answer has been running since December and has mostly gone unremarked. Quantitative tightening ended on December 1st, 2025, and the FOMC instructed the desk to begin reserve management purchases. $40 billion of bills a month, $480 billion a year, roughly half the pace of QE3 at its peak. The stated justification is reserve adequacy, a technical correction to money market plumbing. Not stimulus, and not, on paper, a signal about growth or inflation. Put next to each other, the two operations are not a coordinated trade. Nothing here required a meeting between the two institutions. They are two independent policies, run under separate and individually defensible mandates that happen to add up to the same outcome. The Treasury swaps long duration for short, the Fed absorbs the short paper with newly created reserves, and long-dated debt leaves the public float while reserves take its place in the banking system. Neither institution would call its own action easing, and neither has to be wrong about that for the combined effect to matter. Reserve creation under an ample reserves framework does not pass through the money multiplier the way pre-2008 operations did. It sits on bank balance sheets rather than circulating, consistent with the disinflation still running underneath. core inflation at 2.5% and falling 9 months running, while the fiscal side handles duration risk and the monetary side handles plumbing. What the two produce together, unplanned, is a debt stock that gets shorter and a public float that gets thinner. The precondition, not the proof, for the trust question this essay is actually about. Who ends up holding what once the safest asset in the system stops behaving like a fixed quantity? A third rung has now appeared, the cheapest of the three to build because it does not require buying anything. The Treasury Secretary is pushing to expand the Fed's FEMA repo facility, which lets foreign central banks pledge US Treasuries as collateral and borrow dollars against them rather than sell outright. The facility's ceiling today is $60 billion. The proximate trigger is Japan, whose currency sits at a 40-year low and which has already drawn on the line. Japan holds $1.14 trillion in treasuries, the largest foreign position of any country, and the current ceiling covers just 5.3% of that holding. Use of the facility has otherwise been minimal, with one documented exception: the regional bank stress of March and April 2023. Three instruments now point the same direction. The Treasury's long-end buyback, roughly $96 billion a year, repurchasing duration. The Fed's reserve management purchases, roughly $480 billion a year, supplying the short end. And the FEMA repo expansion. No balance sheet outlay at all, making patience cheaper for a holder not yet forced to sell. FEMA is the cheapest of the three in dollar terms. The political cost is separate and harder to price. Even doubled, a $120 billion ceiling would cover only about 10.5% of Japan's treasury holdings. Nowhere near enough to stand behind a genuinely disorderly sale. A real limit worth stating plainly. What it can do at its current size is narrower than prevent a disorderly sale. It lowers the cost of patience for a holder not yet forced to sell, which matters most before a crisis turns disorderly, not during one. Committing $0 still names a number, and a named ceiling is a named target. Publishing 60 billion invites the market to ask what happens at 61. The tiering, not the facility itself, is what makes this a permission structure. FEMA access is broad and non-discriminatory. Most central banks with meaningful dollar exposure can use it, but above it sits a second tier that is not. Swap lines exist for 5 central banks only: Japan, the ECB, the Bank of England, the Swiss National Bank, the Bank of Canada, with standing unlimited access at preferential terms. Everyone else has FEMA, capped, and nothing above it. Ask who needs dollars with oil trading between $90 and $160 a barrel and holds meaningful treasury positions outside the top tier, and a recognizable set of countries comes up. India, Saudi Arabia, Singapore, Brazil among them, offered here as directional, not verified. Expanding FEMA supplies the second ring with more access, not less. It makes the lower tier more usable without flattening the hierarchy. Japan is the occasion, not the reason the tier structure exists. That reason is currency convertibility and financial depth. Whether the ceiling is raised or removed, and whether Fed Chair Kevin Warsh, who has stated a goal of shrinking the central bank's balance sheet footprint against a treasury publicly asking the Fed to expand its capacity to backstop foreign holders, signs off on it, is the cleanest observable test of who is actually setting the size of the Fed's balance sheet in 2026. That tension is an explicit clash between two specific office holders, not a theory imported from outside. The paper tiger. The same period's second event runs on water, not on bonds. Since February 28th, the Strait of Hormuz has been contested. Iran's own account of the policy is that the strait is closed to its enemies and open to everyone else. In August, its parliament advanced a bill formalizing that into law, banning transit of assets tied to the United States, Israel, and other states Tehran designates hostile, with tolls on the rest and penalties up to 20% of cargo value for violators. 25% of seaborne oil trade and 20% of global LNG trade run through the strait. Dubai crude hit a record $166 on March 19th. Japan shows the filter is not rhetorical. Japan-linked vessels sat stranded in the Gulf for months until Iran's foreign minister confirmed in March that Japanese ships would be allowed through, after which they exited safely by June. Being a U.S. ally did not exempt Japan from needing its own separately granted permission. On August 18th, Iran and Oman agreed on a new route through the strait. The same day, the 60-day understanding between Washington and Tehran expired. And for the second time, the U.S. president threatened to bomb Oman, an ally of roughly 200 years standing, through whose territorial waters the shipping channel runs. Oman's own interest here is not necessarily defection. A state whose waters are the choke point has an obvious reason to keep the passage open and negotiated rather than closed and contested, whoever it has to talk to in order to manage that. The threat to bomb it reads the same either way. Arendt's distinction between power and violence is the compact version of the same point. Power rests on consent. Violence is what shows up once consent can no longer be assumed and can only destroy, never generate, the thing it is trying to protect. The execution of the threat against Oman is secondary. Its public disclosure is what matters. What it discloses is that the order's value to the party enforcing it is no longer the outcome. It is the role. Once two regional powers can settle a transit dispute without the enforcer, that role is visibly optional. Settlement follows the route. The claim that settlement follows the route is not yet an observation. That a seller ends up invoicing in whatever currency the buyer can pay in, once the route deciding who the buyer is gets renegotiated by alliance rather than by price. There is currently no public ledger of contracts showing that switch in progress. No invoicing data for Gulf oil sales after February 28th exists in the record consulted here. That silence is itself worth sitting with rather than apologizing for. The route was reordered in public, in real time, while the currency the new reality gets priced in stays invisible. A market that has visibly changed its physical shape while its pricing data stays dark is not a gap in this essay's research. It is the actual condition traders and reserve managers are operating under right now. What can be shown is the precondition. The same 6 months that reshaped who gets to buy also reshaped who gets preferential access to the currency the sale would otherwise clear in. That parallel is narrower than it first looks. Iran allocates straight passage by alliance, closing a door to some and opening a new one to Oman. The Fed allocates preferential dollar liquidity by relationship, and in the same period opened its own second-tier door wider, not narrower. The two moves point in opposite directions on access, so this is not one closing system pulling another shut behind it. What both retired independently is the older premise that access is something anyone can simply buy at the posted price, universal admission to whoever pays, in favor of privileged access granted by alliance. Same reflex, different levers. Not one mechanism copied twice, but the same instinct toward selective, relationship-based access, surfacing in a currency facility and a shipping lane in the same half year. Neither fact is new. Straight access has always been sovereign territory. FEMA has always been discretionary. What changed in 2026 is that both moved from quiet practice to explicit rule. Iran writing its filter into a parliamentary bill. The Fed's tiering becoming a publicly argued number. Then comes the question almost every account of this shift skips. What is the proceeds held in once, or if, the sale gets invoiced somewhere other than in dollars? None of this required coordination. Two institutions on two continents, each solving a narrow problem inside its own mandate, arrived at the same admission without ever talking to each other. Which makes the resemblance more durable than a coalition, since it depends on no one's continued cooperation. The recycling problem. Invoicing currency and reserve currency are two separate functions, and the gap between them is where most de-dollarization arguments quietly fall apart. Russia has invoiced its Asian oil sales in yuan and rupees since 2022, a real executed shift. and the dollar's share of global reserves has barely moved in response. The reason is capital controls, the absence of full convertibility, and no sufficiently deep yuan asset market to park proceeds in. Winning the invoice only requires a willing buyer on the other side of one transaction. Winning the reserve function requires a market deep enough to hold accumulated wealth for years, a different, harder condition. The yuan clears the first bar, not the second. The exporter who gets paid is rarely the final holder of the problem. The trade surplus it generates gets recycled upward, into the reserve manager who has to decide what to do with an accumulating pile of a currency the state does not fully trust and cannot fully convert. That reserve manager, not the exporter, is who actually needs a third option, an asset neither side has to extend the other institutional trust to hold. That is the strongest argument for a neutral settlement asset, and it has nothing to do with payment speed or new rails. It is a specification that falls directly out of the mechanism above. Several instruments could in principle try to satisfy it. SDRs, a regional currency basket, a bilateral clearing arrangement. None ruled out here, but none of them is what central banks have actually reached for at scale. What they have reached for is the next section's subject. The neutrality paradox. Whichever asset ends up filling the specification from the previous section, it loses something in the process. The neutrality that made it useful stops surviving contact with the institutions that would have to hold it. That is what this section is actually about, and gold is the test case, not the conclusion. Central banks bought 289 tons of gold in the second quarter of 2026, a record quarter, while the price fell 16% over the same period. Tons rising as the price falls is consistent with a buyer that is not there for the trade, but also with opportunistic buying into a discount. The same data supports both readings and without the dollar value of the purchases, not just the tonnage. The stronger claim cannot be fully separated from the weaker one. Harder to explain opportunistically is the trend underneath the quarter. Buying has stayed elevated since 2022, spanning multiple price regimes, initially driven substantially by sanctions risk after Russia's reserves were frozen. A motive with nothing to do with straight transit or treasury operations, which this essay does not need to explain away, only note predates it. A digital neutral asset attempting to occupy that role would need to clear three conditions. Central banks would need to be able to hold it. Under Basel's SCO60 framework, unbacked crypto assets carry a 1,250% risk weight and a 1% cap on core capital, excluding them from reserve holdings by rule, not sentiment. Custody at sovereign scale. Letting a reserve manager hold the asset without depending on a private counterparty's solvency does not exist at the volume a reserve position would require. And the harder condition, a settlement asset for parties that do not trust each other cannot depend on an operator who is also a party to the transaction. Gold does not escape this test by default. It deserves to be run through rather than assumed exempt. Gold held at the New York Fed or the Bank of England is also gold held by permission of a specific institution. Germany moved roughly 674 tons back from New York and Paris between 2013 and 2017. 3 years ahead of schedule, under armored train and military escort, bringing Frankfurt's share of the country's total gold up to about half. Gold's advantage is not the absence of a custody problem. It is that the problem has been tested at sovereign scale, in public, with an exit exercised and honored in full. The same scrutiny belongs on gold's price infrastructure, not only its vaults. The reference price a reserve manager transacts against is set through a small circle of bullion banks and 2 clearing venues, London and COMEX. A centralized party inside a supposedly neutral system, cleared not because the problem is absent, but because that circle has held for decades without a state being frozen out of it. Self-custody, a state holding a digital asset in its own wallet, no institutional counterparty at all, genuinely sidesteps that version of the problem, and deserves credit rather than a wave past. What it cannot sidestep is whether the validators, miners, or protocol maintainers whose cooperation the network depends on constitute a trusted counterparty by another name, one without gold custodian's 200-year record. Several digital settlement projects launched in 2026 make the same move at institutional scale. A neutral layer marketed on top, while onboarding, insurance, or a small set of identifiable entities does the actual trusted work underneath. The industry has not yet produced a settlement layer that avoids this at the volume a reserve manager would need. Put the two tests side by side, and the shape of the gap is easier to see than any occupant sitting in it. Gold clears the trust test and fails the speed test. Nothing about it was built to settle in seconds or to be written into a contract. Ledger-based settlement networks clear the speed test and fail the trust test. Fast, programmable, and still resting on a validator set that someone, at some point, configured, whatever the marketing calls the layer sitting on top of that configuration. Nothing currently on offer clears both at once, though it is worth asking whether both were ever required of the same asset. Tokenized gold is the obvious attempt to bridge the two. Gold's trust record wrapped in a ledger fast enough for the speed test, and it deserves to be named as a candidate rather than left out. It does not yet escape the same test it is supposed to solve. The token is only as good as whoever custodies the metal backing it, which reintroduces a named operator at exactly the layer the underlying metal was supposed to avoid. The recycling problem is a reserve question. A manager holding accumulated wealth for years has little use for settlement in seconds, which matters more to whoever is invoicing and paying than to whoever warehouses the proceeds afterward. Gold and a faster digital rail could end up doing different jobs in the same chain instead of competing for the same one. The dollar earned both roles through decades of institutional depth, not through speed. That possibility does not close the gap. It means the gap may not need one asset to fill it. The gap is real and specific, and it is worth stating without softening it into a forecast. Nothing currently on offer clears both the trust test and the speed test. Gold and a faster digital rail may end up answering different halves of the same problem rather than competing for one answer. No invoicing shift has yet been shown for the Gulf trade that would force reserve managers to act on any of this at all. Each of those three facts is individually survivable for the system that has to route around them. Together, they describe a specification with no confirmed occupant, sitting underneath a stack of institutions. Central banks, exporters, straight operators, bond desks, that are already behaving as though the old premise that access is something anyone can simply buy at a posted price no longer fully holds. An unfilled specification that several major balance sheets are already pricing around is not a curiosity. It is a fault line that is not finished moving, and the next visible event on it, not the one this essay predicts, but whichever one arrives first, is more informative than any conclusion this essay could offer in its place. That was Janus Dispatch. Sources, charts, and disclosure are in the published post. If this dispatch sharpened your read, subscribe. Janus Dispatch is at janusthewatcher.substack.com. The long arguments are in the books. The transition sequence. 2 volumes, 1 thesis, the ground is shifting. Book 1, The Proto-Post-National Age. Book 2, The Frame. Both available on Amazon, paperback, and Kindle. The dispatches connect them. The books carry the weight. Architecture over narrative.